But as I will just say it again, it is just one of an ever-increasing number of factors that has petrified me on what can happen in the U.S. stock market. 80 to maybe as many as 90% of Americans, past the 50% who are just working paycheck to paycheck and have no room for error, the largest amount of people are living at least one lifestyle higher than their finances support. The market that has been near perfection for me for years. And when you've been this long being this right, you keep saying to yourself, because you remember the years when you were badly wrong, where does it go wrong? But so far, what I've done with the two key metals, gold and silver, has been near perfection. Every conceivable non-government way of looking at employment paints a totally different picture than the BLS once again painted today. Remember, it stands for the Bureau of Labor Statistics. I and many others believe it should stand for the Bureau of Lying Statistics, and they can remove the L and it'd be better served just to be the BS. We know that Trump replaced key personnel there, and we know how people best to stay on the right side of Trump, what needs to be done. And I believe that we will see once again, as we just saw the numbers for all the previous year, will be revised greatly downward. It doesn't make any sense when ADP and so many other organizations who don't have an axe to grind as the government may have to paint a better picture than reality, have a far different outcome on how they see the employment picture. Having said all that, and if you take the numbers on face value today, then how do you get dramatically lower interest rates if employment is so strong? Now, we know that this is almost certain to be revised. But as I will just say it again, it is just one of an ever-increasing number of factors that has petrified me on what can happen in the U.S. stock market.
Official labor statistics continue to project resilience, yet alternative data sources tell a different story. Private payroll processors and independent surveys suggest softer employment trends than government releases imply. Historically, labor data revisions often trend downward months later, reshaping the narrative after markets have already reacted. Strong employment readings also complicate the case for lower interest rates, limiting central bank flexibility. If economic weakness is underestimated today, policy responses may arrive too late. In modern markets, perception drives momentum, but when perception diverges from reality, corrections can be abrupt. The question is no longer whether revisions will come, but how markets will absorb them.
As I've said, 80 to maybe as many as 90% of Americans, past the 50% who are just working paycheck to paycheck and have no room for error, the largest amount of people are living at least one lifestyle higher than their finances support. Now, people say, how do they do that? Well, they borrow. 2, they don't fund the things that are important, retirement. You see the numbers now, how little people have saved in retirement. They don't fund child's education. They deferred maintenance to homes and other things in order to live a lifestyle above where their finances truly support. They do not want to exercise the living model that I've had for over 25 years for myself and in business. Less is more. And because of that, that's why the troubles will be far greater down the road than they would have been, because most people will not have been in a position to handle that. And they will call on a government to help them at a time when the government is in a precarious position itself and all. So that's kind of the big picture. Nothing's changed there. I believe it's all added. Here's how I suggest people consider, and again, if you're a client, you will have talked this over with our planning group, and that is to use mechanisms, both equity index annuities and ETFs that mimic them, to where you will give up some of the potential upside gains in order not to lose as much, if any at all. And I think that's the way to approach the equity market until further notice. If you are going to be aggressive, I believe outside the United States is better. The United States is witnessing, and again, this upsets the MAGA people, and I get nasty emails. and so forth. There's one in the other room that's as MAGA as they come, and that is Trump has made a crucial, critical error on alienated the rest of the world. And because of that, he's accelerating the movement away from the United States, including the sales of U.S. assets at a time when we can ill afford it, including treasuries, bonds, and holdings, and also ability to, if trouble occurs, who's going to be standing there with us. I would say if we had 20 good allies 20 years ago, we may have 2 or 3 at the most now.
Beyond market metrics lies a broader societal imbalance. A significant portion of households operate one tier above their financial capacity. Lifestyle expansion, financed by borrowing rather than savings, has replaced disciplined capital management. Retirement accounts remain underfunded, maintenance deferred, and education savings postponed. Debt fills the gap. This vulnerability becomes critical during downturns, when income instability collides with elevated living costs. Should equity markets contract meaningfully, many households lack buffers to absorb the shock. Government support may be expected, but fiscal conditions are already strained. Financial fragility at both household and sovereign levels creates a feedback loop that amplifies economic stress during crises.
What I'm just saying to you is, I think general equities, you have to take a bearish approach. And the older you are, the more gray or less hair you have, the more conservative you have to be. For me, because I've taken just one huge position in a stock, the rest is liquid. It's in T-bills, CDs, and government money market funds. That, I believe, erring on the side of caution, making capital preservation versus capital appreciation paramount. I hope that, again, makes everybody aware of that, and that's where I stand on that. In terms of bonds, I don't want to own any. We do have one of our team members, Bob Farrell, who has some belief that there are some worthy corporate bonds. I'm not in that camp, but probably somewhere in between Bob and I is a good way to be. But I don't want to own anything that's past 1 year here, and that's why I stay in T-bills. I would also point out overseas that what is transpiring in certain bond markets, which the most prevalent one in Japan, is going to have a negative impact on us. We'll talk more about that as I do on the day-to-day stuff that I do. Now, the market that has been near perfection for me for years, and when you've been this long being this right, you keep saying to yourself, because you remember the years when you were badly wrong, where does it go wrong? But so far, what I've done with the 2 key metals, gold and silver, has been near perfection. Riding it up, moving into major mining stocks, moving into juniors, and then when the insanity that came in the first run up well through 5,000 and 100 silver, calling for a sharp correction. That happened in just a matter of a couple of days. The target that I had as a downside of 4,400 was hit within $4 by gold. What's the old saying, rather be lucky than good? If that's what it was, so be it.
In an environment marked by elevated risk, preservation may outweigh pursuit of aggressive gains. Short-duration instruments such as treasury bills, high-quality cash equivalents, and structured products that limit downside exposure offer defensive positioning. Long-term bonds remain vulnerable to volatility, particularly amid global pressures like Japan's shifting yield dynamics and rising sovereign debt concerns. Geopolitical realignment also matters. U.S. policy decisions have strained alliances, accelerating diversification away from dollar-denominated assets. Reduced foreign demand for treasuries could reshape capital flows. When uncertainty expands, liquidity and flexibility become strategic advantages. Defensive positioning is not pessimism, it is preparation.
I think the metals have a much better performance opportunity than any other sector at this point in time. Finally, the dollar, as I've told you, and I've said for a while, I've called it terminally and it's dead. No one just wants to tell it. It's going to continue to work its way lower because of some of those things that I spoke about, Trump and so forth and so on. Oil, which I have no opinion on one way or another. And finally, Bitcoin. It's a con. It couldn't even rally back to the neckline that I spoke about from that head and shoulders pattern, which signaled when we were up well above 100,000, telling everybody, get out. We've seen the highs in Bitcoin. They throw out all these people again. I put a post out this morning. Cathy Wood, Saylor, Kramer, the three of them, they're the three stooges. They are the three stooges of the 21st century. And Tao TV, CNBC just keep wheeling them out and bring out all these people and all. And then you see how much the Trump family has made in billions from trading the cryptos and getting out. And yet these people are still following people like that and all.
Amid uncertainty, precious metals continue to strengthen their strategic role. Recent corrections in gold and silver appear more technical than structural, suggesting consolidation rather than collapse. Historically, metals perform well during periods of currency debasement, geopolitical instability, and declining real yields. Unlike speculative surges, measured advances often indicate sustainable momentum. Mining producers, particularly established operators, may benefit from expanding margins if metal prices trend higher. While volatility remains possible, the broader macro backdrop favors tangible assets. In cycles of monetary stress, capital frequently migrates towards stores of value. Precious metals are once again positioning themselves at the center of that migration.
Bitcoin's going a lot lower. Now, please, I made this point. Don't confuse, because some of you email me about this. I'm a believer in stablecoins. I believe in this tokenism that's coming. But I wouldn't touch an NFT, mem coins, which I've told you, I'd rather own a pile of crap. At least I can put that in my backyard and make it fertilizer. The only thing the mem coin has going for it is there a greater fool than you who bought it that you can sell to at a higher price? And the Bitcoins and Ethereum and those things, they're going to be near zero. That's where I stand. I think that covers anything. I have to go give a talk today that I talked about. It's very emotional for me to go to St. Veronica's Church, whether there's one person there or 100. The widow of my best friend will be there. And the priest that was so important to me for a lot of years is not there anymore, but a new priest has come in, a parish priest, who's really filling the shoes. And that's why I'm willing to go there. And it'll be a bit challenging, but it's the most influential place in my life. More has happened because of that place than any other single place. And I look forward to doing it.
The US dollar faces long-term structural challenges, including rising debt burdens and shifting global alliances. While it remains dominant, incremental erosion of confidence can compound over time. Digital finance, including stablecoins and tokenized systems, may influence future settlement infrastructure, but speculative cryptocurrencies face credibility questions as volatility persists. Markets that rely purely on momentum are vulnerable when liquidity tightens. In contrast, assets tied to tangible value or cash flow tend to endure. The coming years may mark a broader monetary transition, not sudden collapse, but gradual rebalancing. In that transition, discipline, liquidity, and real assets could define financial resilience.